This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
Okay, welcome back to part two. So as I was saying, the example I was giving for a compulsory acquisition and compensation exercise, we have a property here that is being acquired, compulsory acquired, and as you can see, the purple lines on the plan show the area that's going to be acquired for the two roads. What's going to be left in ownership of the current owner is the northern portion of land here with road frontage there. This will be a road, this will be an additional road, so this land is being acquired, and this triangular section will be left in the current owner's ownership, and this land here will eventually have access to the road that constructed, but for all intents and purposes this is going to be landlocked for a while. So as you can imagine, it's quite an exercise in fairly compensating the owner of this property for this particular acquisition. And you can have a number of valuers together in a room, and they're all going to come up with a different estimate of what the current owner has suffered as loss. So this is obviously an extreme example, but this subject will go quite a way to giving you the skills and tools to arriving at what's a fair compensation for this particular compulsory acquisition. The things that we need to take into account when assessing fair compensation, especially in a partial acquisition, it's always easier to arrive at the value of a property when the whole of that property is being acquired, but when part of the property is being acquired, what's the loss that's being suffered? And the underlying principle is fair and just compensation to the owner or to anybody who has an interest in land. So I keep saying property owner, but anybody who has an interest in land is entitled to compensation, and that obviously includes a tenant who might not own the land but has a long-term lease, or even for that case a short-term lease. So what's the loss that they have suffered? And the general rule of thumb that we look at when trying to assess fair compensation is the party in question, what do we need to do to put them in a financially similar position as to what they were in prior to the acquisition? Now, whilst that's the underlying objective, as you can imagine, especially in this case, it's not always easy to determine what is putting the owner or the tenant in a similar financial position as they were in prior to the acquisition, because in some cases it's very difficult to quantify the amount of financial loss that they've suffered by having to either move or the loss of this land in their ownership. But we'll be looking at that in the second half of this semester and dealing with the compensation. Okay, so let's move to the next slide. So just as an overview, how does this subject going to run for the next few months? And as I said, this week's class is an overview and an introduction. Weeks 2 to 5 will be made up of rating valuations. We'll be looking at specifically how we achieve a valuation for rating purposes. Week 6 we will look at GST and other taxes, including land tax in particular. That's quite a complex tax system. We'll be looking at that. Weeks 7 to 10 we'll be looking at compensation valuations, and week 11 VCAT and court overview, and with a subject review in week 12. As I said earlier, there'll be 3 major assessments, and I've left that last sentence in there. There will also be a mock court case scenario where every student will be involved in and assessed on. I'm just not sure how we're going to do that remotely, but let's keep that as a possibility. So I'll have more information on that as we move through this semester. Just some general overview, depending on the exposure that you had to valuations and specifically to government-based valuations. Here's some things that you should start looking at. Sharpen up your knowledge on the valuation fundamentals. And obviously you should have a handle on the 3 fundamentals, and that's the 3 valuation approaches, that is, and we've got summation, direct comparison and capitalisation. Again, if you haven't had a lot of exposure to those valuation methodologies, please let me know. We'll be looking at introduction to taxation and valuation concepts. Why a taxation system based upon property values? What does that look like? There's some reading material there for those that are interested. The history of property taxation, and I suppose the most important one to look at is the most recent, which was the Henry report done in, let's change that, 2008. That's a worthwhile one. That really, the federal government commissioned a report, and quite a lengthy report, to look at taxation, the taxation system right across the country, and certainly some of the aspects of that were put under a microscope, and the recommendations are to have something a bit more uniform across Australia rather than the different systems that we have in each state. We'll be looking at the valuations best practice program in Victoria, the rating system, and some major overhauls that have occurred in recent times. Okay, so let's start off and look at one of the fundamental definitions of market value in Australia. So the Australian Property Institute quotes the definition of market value as the following. Market value is the estimated amount for which an asset should exchange on the date of valuation between a willing buyer and a willing seller in an arm's length transaction after proper marketing, wherein the parties had each acted knowledgeable, prudently and without compulsion. Okay, so what does that mean, and why is it important for you to understand this concept? So this concept is known as the Spencer Principle, and it's known as the Spencer Principle because it came out of a court case, a High Court of Australia court case, and it was a compensation dispute, and out of that court case the definition for market value was created in Australia. So quite a watershed moment in the court system, and since that court case it's the accepted definition of what market value means. So when the bank comes along to a valuer and says, I want you to estimate the market value for mortgage purposes, we use this definition. If you're doing a valuation for purposes of for selling the property and estimating to the vendor what they might achieve, it's on this basis. So the amount, I suppose, in simplifying this term, it's the amount at which the vendor of a property and the purchaser agree to transact, to dispose, to purchase. So in most situations, a vendor has always got an overinflated, I don't know about the moment, but generally speaking, has an overinflated opinion of what their property is worth, and vice versa. The purchaser always thinks the asking price is too high. So the definition of market value is the figure at which both those parties agree. Now, it's not just as simplistic as that, what they agree on. It's also about making sure that they both act impartially, and they also act with knowledge, that both parties know all the attributes involving that property, what's important for that particular property to know that affects market value is known by both parties. So what does that mean? That something that would dramatically affect the value is not hidden. For an example, what would that include? Let's say an older residential property where the roof is full of asbestos. The vendor knows this, keeps it quiet, sells the property and doesn't disclose that information, which is illegal, and the purchaser purchases it. That, under those circumstances, that's not a true test of market value. What would be a true test of market value is that the information in relation to the asbestos in that residential property, or could be a non-residential property, is known by the vendor and is disclosed to all interested parties. With that information known by both parties, what is the figure that is transacted for a sale? So that gives you a very simple general definition of what market value is. So it's extremely important for you to firstly understand the definition, the accepted definition of market value, before we can proceed to talking about the concepts and the principles in rating and taxing valuations. So this is the first point at which we start. You need to fully understand this definition before we can move on. So make sure you have a look at the Spencer case. There's a one-page summary, I think, that I've attached somewhere along the lines, and worthwhile reading that to get a background of what the court case was about. As I said, it was a High Court decision, so the highest court in the country, so it carries extra weight because of that particular reason. And out of that comes a definition which has since been accepted throughout Australia as being the definition for market value. Okay, so I also want you to read, you've got some reading assignments to do in the next week or so. And the first thing I want you to familiarise yourself with is the Valuation of Land Act 1960, an important act, and this subject is connected crucially to this legislation. So make sure you start reading the Valuation of Land Act 1960 and are aware of the parts to it. We'll be also looking at numerous valuation principles. We'll also be looking at some court cases that have occurred, and whilst VCAT is not a court, it is a tribunal, there's two cases in particular that we're looking at in detail in the next week or two. And the first one is 187 Settlement Road, Proprietary Limited versus the City of Whittlesea. Very important court case, well, tribunal case rather. Important because it tests the definition of market value against the principles of rating valuations. So that's an important court case. The next one, AusNet Electricity Services Proprietary Limited versus City of Whittlesea. Again, two cases that I was involved in. This one's a particular one, a particularly interesting one, because it talks about a substation and whether a substation is rateable or not for council rates. So that's also an interesting one for you to have a look at. So make sure you read both of those in the next week or two. It's also important for you to brush up on your valuation principles. I need to have an understanding as to what level you're at, what exposure you had to valuation principles in your career so far. So we might have a discussion about that at the tutorial of how you can give that information to me. As I said earlier, also want you to start brushing up on your Excel statistics skills. Assignment 2 will be quite complex, and you'll be looking at utilising the statistical package within Excel, which you might not even be aware exists. So we will be exposing you to the Excel functionality as it relates to statistics, statistical analysis. And if it is possible, I also want you to have a good look. The council rate notices across Victoria are being posted as we speak, but if you haven't quite received yours yet, see if you can get last year's council rate notice from your parents or colleague, and have a look at what information is on the rate notice. Now, you've probably never had a close look at yes, we'll be having a close look at your council rate notice too. So start having a look at that information that's on there. As I said, you might not have had a chance ever to have wanting to be particularly interested in looking at your council rate notice. Well, now's an opportunity to have a look at it and see what information's on there, and we'll have a closer look at a rate notice in the next week or two. Okay, so there's some things to do during this next week. So in particular, look at the VCAT case tribunal of AusNet Electricity Services Proprietary Limited versus the City of Whittlesea. There's a link to the decision, and the question I will ask you, and see if you have an answer ready for me next week: are substations rateable? So in your opinion right now, what would you think about that? Is that a rateable property or a non-rateable property? And we'll go into much more detail in the next week or two. Okay, so this week's class, what I particularly wanted to cover, the first part of this subject will be looking very closely at the property rating system in Victoria. Now, the property rating system in Victoria, you're going to be exposed to a number of concepts which are going to seem pretty odd to you. And you're going to be asking yourselves, why would we particularly have a system, an unusual system that we've got at the moment? And the answer to that question is, it's based on history. It's based on a system that's been used for many, many years. That doesn't mean it's right, but to understand why we do things today, you need to understand how we've done things in the past and where particular concepts came from. And I think the best way to understand why we do things today, and this relates to anything, is to understand how they've evolved. And history, property taxes have a very interesting history, and we're going to go through that in the next few minutes now. So you've got this as part of your subject reader too, so I've made that available to all of you. So that's got this information, history of property taxes in a lot more detail. I'm just going to go through in a summary basis what the highlights are. Okay, so earliest tax records. I'm talking about property tax records. Has been uncovered in Iraq. That was in what used to be called Lagash, 6000 BC. So you think about it. The first known records for property taxes was found 6000 BC. 6000. BC. In 5000 BC, ancient Egypt levied taxes on the value of grain, cattle, oil, beer, and land. And during this time, so we're still going back to 5000 BC in ancient Egypt. So during this time, tax assessors became prevalent. Tax assessors were also highly valued officials in ancient Greece. Why would you think that would be the case? Well, I suppose governments back then relied heavily on income from property owners, and the tax assessors were the link between property owners and the governments to ensure that they were paid and that they received their fair share of revenue. So that's how far back these systems can be traced. If we're more closer to recent times, we've all heard of Alexander the Great, who was around in power a fair chunk of the globe. He was in control of 356 BC to 325 BC was roughly his reign. And he introduced a pretty fair, or a fairer system of raising property-based taxes on all the colonies that he conquered. So, as I said, he ended up controlling a fair chunk of the earth. But each time he conquered an area, he would, because these were pretty uncivilised colonies that he was conquering, but he would introduce, in each new colony that he would conquer, he would introduce property-based taxes. And they'd never heard of, in most cases they would never have heard of these systems. So he would set up the systems, put the infrastructure in place, appoint tax assessors, and he would levy taxes and collect them. He was pretty smart. What he did was he would take a percentage of those taxes back with him, but he also would reinvest a fair percentage of those taxes that he would collect in a particular area back into that community for infrastructure. So again, pretty progressive thinking when you think of it. It's still 350 odd years BC. And he came up with the idea of reinvesting collected property taxes. And this would be for roads, general infrastructure in the area, schools, all those sorts of things, government community centres. So again, pretty progressive, and it's a forerunner to what happens today in the three levels of government: council, municipal boundaries, state governments and federal governments, collection of revenues and a reinvesting of those revenues back into the community for infrastructure. In 200 BC to 300 AD, the Romans levied property taxes on the value of lands, buildings, livestock, trees, vines and other personal property. So now you can see the system of taxing expands, not just to property and livestock and crops, but starts to expand to personal property, what people personally own. So already between 200 BC and 300 AD, you see the system now expanding. So governments are trying to now collect more than what they were previously. I suppose by that stage, property owners started to get a bit annoyed at the amount of taxes that were being collected. And especially when you had a tax on your crops. So not only were you paying taxes on the land and the value of the land, but also what was on top of the land, what you were growing. So you're penalised to a certain extent on the crops. So a lot of people, so the records show, when they were starting to get this high level of annoyance of how much they were being taxed, would simply not bother growing crops. And so the officials started noticing this. But it wasn't until when Augustus Caesar came into power and he could see this growing, this trend of not necessarily growing all the crops on your land because you didn't necessarily want to be taxed on them. So Augustus Caesar, when he was in power, he actually varied the property system, the property taxing system rather, to not only take into account the land and the crops, but he would also came up with a system where he would tax properties on their potential rather than the crops they produced. So this was pretty clever. So not only would he tax the land, but he would come up with the value of your land would include the potential for what they could do. And this is during his power. So again, pretty progressive thinking. So what do we think about that? So he would value, properties would be valued on their potential rather than their actual use. So that might seem similar to some concepts that you've been exposed to, and you'd be right. So this variation in the property taxing system that Augustus Caesar introduced was the forerunner to what we know in today's terms as highest and best use. And this presents a challenge not only to valuers and property owners, but also those that implement the current property taxing system, where a property is being used in a certain way, but it's being taxed or rated on a different level. And the most common and easily recognised example of that would be a farming property, and here at Whittlesea, where I'm working currently, this happens quite a lot, where you have a farm that's been a farm in the generation of that particular family for many, many years, and has always been used as a farm and generally always been valued as a farm. But with the flick of a pen, the state government now includes that farm as development land. Now, whether that's residential development land or commercial industrial development land, it doesn't really matter. The value of that property against it as what it's being used for as a farm now increases dramatically. Now, using the principle that Augustus Caesar came up with way back then, in these cases today, the property is a farming rural property worth $5 million, for example, and as I said, has always been farmed for all of the years that this particular family has owned it, which goes back a number of generations, and is currently being farmed, but now gets rezoned. For this example, let's say to residential, so it can now be developed residentially, and the value of that property skyrockets. So under the highest and best principle, the property value goes from $5 million, let's just say for argument's sake it goes to $50 million. So that person, the current property owner, has not changed the use. It's still being farmed and continues to be farmed, and he still will farm it into the future. But because of the rezoning of the land, the value has changed overnight and goes from $5 million to $50 million. And from a highest and best use principle, the value of that property, not only under the Spencer definition, that's what can he sell it for, but also under the definition of what he pays rates and taxes on. He pays, or that family pays rates and taxes based on the $50 million. So is that an anomaly? Unfair part of the system that's been in place now and has been in place ever since Augustus Caesar introduced this principle. So not only do you pay property taxes on the value, fair value, but also on the potential. And so that goes back many, many centuries and is still a concept that is being used today. In the 11th century, Lady Godiva, you would have all heard about her in school, I would imagine. So she rode naked through the streets of Coventry, England. And she rode naked specifically to protest her husband's property taxes. So way back then, and I would assume even earlier than that, people were very annoyed and frustrated at the level of property taxes placed on their particular holdings. And that's nothing new. I mean, that would have occurred from day one that the property taxing system was introduced, and certainly exists today. People, property owners and tenants are particularly frustrated with the level of rating and taxing that they are subjected to. So that's what I'm saying. It's extremely important for you all to understand the concepts in this subject, so you can better explain to your clients, and some of you might end up working for government, so it's important for you to understand the system to apply that system correctly. But for those of you that are going to work in the private property industry, to be able to advise your clients who are property owners and occupiers whether they're being taken advantage of from the current system that we have of raising property rates and taxes. In 1066, during William the Conqueror's reign, cadastral records were kept on all properties, also known as the Domesday Book. So we have specific and very descriptive information on all properties within Victoria. We have over 50 pieces of information recorded on every property in this state. And that's nothing new. A system of recording that information was invented and created by William the Conqueror way back then in 1066. Don't know about the name. Domesday Book, I can certainly understand why it received that name, but that certainly was a forerunner to what we use today. It's certainly not hard copy. Everything's computerised these days, and I'll show you an example of how that information is captured. But certainly back in 1066, that's when they started keeping accurate cadastral records on every specific property in a specific area, and we do that today. In 1215, the Magna Carta was signed. Now you've probably all heard of the Magna Carta. What really did that do? It was an agreement, legislation signed, which limited the king's ability to raise property taxes. So back in those days, every time the king or whoever's in power wanted some more money for whatever reason, fighting a war or building new infrastructure, what they would simply do is raise property taxes. And the Magna Carta restricted the limit of how much the king could increase property taxes in one particular year. So that's in 1215. So about 5 years ago in Victoria, the state government introduced legislation that limited how much each council can increase their property taxes, rates and taxes. And so that was limited back at that stage, and it's still in place today, generally by the level of inflation. So this year's rate, we call it a rate cap. The state government introduced a rate cap some years ago, and they change it each year by the amount at which CPI is increasing, and this year's rate cap was fixed at 2%. So again, where we can see examples of principles and practices that happened many, many years ago that we're using today. And why are we using them today? Because they're not, as I said earlier, these aren't perfect systems and principles, but they're the best that we have come up with. And that's why they're still being used today. There's obviously modifications on what have been used many, many years ago, but a lot of the principles are still being used unmodified today. And there's just an example of some that we use today. So again, it's important for you to understand why we use certain systems today and how they've evolved for thousands and thousands of years, why they in a lot of cases are continued today, because we haven't been able to come up with any better system. It's the most fairest system, not a completely fair system, but the most generally fair system across all aspects of property ownership. Now, I'm going to show you some examples in the next week or two of where they are unfair, but as an overall system, no one has been able to come up with a fairer system of raising property rates and taxes. So let's just flick through some of these. This is just some general information I've put in for you to look at, and the various systems that have been used in the past as it relates to rates and taxes. So have a read through these. The rates taxes in Lagash were typically low, but in times of crisis or wars, the rate would be 10% of all goods. What does that sound like? 10% goods and services tax. The primary focus of early property taxation was land and its production value, and taxes were often paid with a portion of the crop yield or some other food. These taxes were used to supply the defence of the city-state and for trade with other city-states. Cattle count. Have a read of this at your leisure, but the best way for a king to assess what was due him from the regions of his country was to go out and see it for himself. As early as his reign, institutionalised during the Second Dynasty and continuing through the time of the Old Kingdom of Egypt, an annual event was instituted, better known as the Egyptian cattle count. Now, at the moment in Victoria, we undertake a general valuation, the valuation of all properties on an annual basis, as at the 1st of January each year. So again, close similarities to what's happened in the past. Egypt was divided into districts, and the fields and produce of every district were assessed for taxes. Similarity to what we have now in municipal boundaries. Each district was divided into provinces, sort of administering the overall operation of the nome. The Rosetta Stone, again, a lot of information inscripted on this significant artefact, and a lot of information in relation to rating and taxing appears on there as well. Domesday Book, that's a hard copy document obviously, but a clear record of information kept on every single property, known as the Domesday Book for obvious reasons. The Magna Carta, again, an agreement restricting how much the king or whoever was in power can increase property rates and taxes by. So have a look through the subject reader, which has got this information in a bit more detail, and we can have a discussion about that on the tutorial if you have any questions in relation to information. And certainly in the past, I've included exam questions in relation to understanding and explaining the history of rating and taxing, and I think for obvious reasons that's quite important for students to understand. Why we do things today is based on how they were done for many thousands of years in the past, and generally speaking, it's the fairest system that we've been able to come up with. Not sure whether you've had a look at the film The Castle, but if you can, just have a look at these short little videos, quite interesting. The film The Castle was made some years ago. It's an Australian film and talks about, funny enough, statutory valuations in it. Talks about council rates and valuation process, and talks about the assessment of compensation. So if you get a chance, see the whole movie, because it is an Australian classic, and I'm sure for those of you who haven't seen it will enjoy it. But these two snippets just give you a little bit of information on some of the principles that we'll be looking at in the next couple of weeks. Okay, so some reading. What I'd like you to do is have a closer look at the history of property rates and taxes. As I said, have a look at the Valuation of Land Act 1960. Also, have a look at the Local Government Act 1989. Now, that's quite a large act, so really all I want you to look at is section 154. Have a look at that section, and also have a look at the Spencer court case, Spencer versus Commonwealth, in particular the definition for market value. Okay, so assignment 1, you might be thinking it's a bit too early to get an assignment, but because I've had to juggle things around this semester, I thought it's best that we get off and running. So this is, well, I think a reasonably straightforward and easy assignment, and what I want from you all is a go at explaining